Good evening. If you're watching this video, you're likely someone who pays attention to the financial system, someone who understands that beneath the surface of daily market movements, larger forces are constantly reshaping how money works, how banks operate, and how wealth is preserved. Today, we need to talk about something that has quietly moved from regulatory theory into banking reality. And I want to do it without the drama, without the hype, and without the predictions that flood social media every time gold or regulations are mentioned. What I'm going to share with you is straightforward information about a regulatory change that has been years in the making. Basel III. You may have heard the term. You may have seen headlines. You may have seen claims that banks are now being forced into holding physical gold at unprecedented levels. Let me be clear from the start. I'm not here to tell you what to buy or sell. I'm here to help you understand what's actually happening, why it matters, and how thinking investors process this kind of information. Because in a world of financial noise, understanding beats reacting every single time. First, let's establish the facts without distortion. Basel III is a set of international banking regulations developed after the 2008 financial crisis. The goal was simple: make banks more stable, more transparent, and better able to weather financial storms. These regulations have been phased in over more than a decade, and various components have been implemented at different times across different jurisdictions. One of the most significant changes involves how banks classify physical gold on their balance sheets. Under previous rules, gold held by banks was treated as a Tier 3 asset. This meant banks had to apply a risk weighting that essentially discounted its value for regulatory purposes. Physical gold, despite being the oldest store of value in human history, was treated more like a speculative position than a reserve asset. Under Basel III, that changed. Physical gold has been reclassified as a Tier 1 asset. This is the same category as cash and sovereign bonds. It means that physical gold held in unencumbered allocated form now receives a 0% risk weighting for regulatory capital calculations. Now, here's where the confusion begins. This does not mean banks are forced to hold 85% of their assets in physical gold. That claim misunderstands how banking regulations work. What it does mean is that when banks choose to hold physical gold, the gold is now treated far more favorably than before. It can count toward their capital requirements without the heavy discounting that existed previously. This is a structural shift. Not a dramatic overnight revolution, but a meaningful change in how the global banking system views and accounts for gold. And structural shifts, even quiet ones, have consequences. Let me explain why this regulatory change is more significant than it might appear on the surface. For decades, the financial system has operated on a foundation of paper assets: bonds, derivatives, securitized debt, digital ledger entries. The system is built on layers of claims and counterclaims, all ultimately resting on the assumption that central banks and governments can manage the value of fiat currencies effectively. When banking regulations treat physical gold the same as cash and sovereign bonds, they're making a statement. Not a political statement, but an economic one. They're acknowledging that in terms of balance sheet stability and crisis resilience, physical gold belongs in the highest tier of asset quality. Think about what that means from a systemic perspective. Banks operate under strict capital requirements. They must hold certain levels of high-quality assets to back their lending and operations. Prior to Basel III's full implementation, holding significant physical gold wasn't particularly attractive from a regulatory standpoint. The risk weighting made it inefficient. Now, that calculation has changed. A bank can hold physical gold and have it count fully toward their Tier 1 capital. No haircut, no discount. Full value. This makes gold more attractive to hold as a balance sheet asset, particularly in an environment where sovereign debt quality is increasingly questioned and currency stability is anything but certain. Does this mean every bank will immediately start accumulating gold? No. Banking is conservative by nature, and changes happen gradually. But the incentive structure has shifted. And in finance, incentives drive behavior over time. To understand why this matters now, we need to zoom out and look at the macroeconomic environment we're operating in. Global debt levels are at historic highs. Governments, corporations, and households across developed economies are carrying debt loads that would have been unthinkable a generation ago. In the United States alone, federal debt has exploded past levels previously seen only during major wars. This debt exists in an environment of persistent inflation pressure. Despite central bank efforts to manage price stability, the fundamental forces of currency debasement, supply disruptions, and fiscal expansion continue to erode purchasing power. You feel this every time you buy groceries, pay insurance premiums, or look at housing costs. Central banks find themselves trapped between competing objectives. They need to maintain confidence in fiat currencies while simultaneously managing unsustainable debt burdens through some combination of inflation and financial repression. This is not a conspiracy theory. It's basic math and historical precedent. In this context, Basel III's treatment of gold isn't happening in a vacuum. It's happening at precisely the moment when questions about sovereign debt sustainability, currency stability, and long-term store of value are becoming increasingly urgent for institutions and individuals alike. When you see regulatory bodies elevating the status of physical gold in the banking system, while governments struggle with debt and central banks navigate impossible trade-offs, you're witnessing a recognition of reality, not a change in reality, but an acknowledgement of what has always been true about hard assets in times of monetary uncertainty. Let's talk about how large institutions approach gold differently than retail investors. For a central bank or sovereign wealth fund, gold isn't a speculation. It's not about making a quick profit or timing the market. It's about portfolio stability, geopolitical hedging, and preserving wealth across generations and through regime changes. When China adds to its gold reserves, when Poland increases its holdings, when central banks across Asia and the Middle East diversify away from dollar-only reserves, they're making calculated decisions about long-term risk management. They're not trying to flip gold for a 20% gain next quarter. The Basel III changes matter to these institutions because regulatory treatment affects their decision-making framework. If holding physical gold becomes more capital efficient, more institutions will allocate toward it as part of their reserve management, not overnight, but steadily over months and years. This is important for individual investors to understand because institutional demand operates on a different timescale than retail psychology. When you see headlines about banks or central banks adjusting their gold positions, that's not hot money chasing momentum. That's deep strategic thinking about the next decade and beyond. And here's what that means practically. Institutional demand creates a floor. It creates consistent buying pressure that isn't dependent on speculative excitement or fear cycles. It's structural demand based on balance sheet needs and regulatory incentives. If you're someone who already holds physical gold, whether coins, bars, or allocated holdings, let me speak to you directly for a moment. First, nothing about Basel III changes the fundamental reasons you likely acquired gold in the first place. If you bought gold as wealth insurance, as a hedge against monetary debasement, or as a multi-generational store of value, those reasons remain intact and arguably stronger. What has changed is the institutional backdrop. The asset you hold is now being recognized formally by the global banking system as a top-tier reserve asset. This doesn't make you right or wrong about your investment thesis, but it does mean the system is moving in a direction that validates gold's role in a stable financial structure. Your job now is not to react emotionally to every headline or price movement. Your job is to maintain perspective and discipline. Gold is not a get-rich-quick asset. It never has been. It's wealth preservation that happens to be repriced periodically based on monetary conditions and systemic stress. If you hold gold, continue to think about position sizing appropriately. Most serious wealth advisors suggest gold as a portfolio allocation of somewhere between 5 and 15%, depending on individual circumstances and risk tolerance. This isn't about going all in on any single asset. It's about balance, diversification, and having insurance when the system experiences stress. The Basel III framework strengthens the long-term case for holding gold, but it doesn't eliminate volatility or guarantee anything in the short term. Markets are complex. Prices fluctuate. Your discipline and time horizon matter more than any single regulatory change. Now, if you're watching this and you don't currently hold any gold, physical or otherwise, what should you take away from this information? First, resist the urge to rush into any decision based on urgency or fear of missing out. That impulse destroys more wealth than almost any other force in investing. The fact that regulations have changed doesn't mean you need to act tomorrow. What it does mean is that you should educate yourself. Understand what role, if any, hard assets should play in your overall financial plan. Understand the difference between physical gold, gold ETFs, mining stocks, and futures contracts. They are not the same thing, and they serve different purposes with different risk profiles. If you decide that some allocation to physical gold makes sense for your situation, approach it systematically. Learn about reputable dealers. Understand premiums and storage options. Think about liquidity and long-term holding periods. Don't buy gold the way you might buy a trending stock. Buy it the way you would purchase insurance or make a strategic allocation that you don't intend to trade frequently. Remember, the purpose of holding gold is not to outperform the stock market over the next 6 months. The purpose is to have an asset that maintains purchasing power when currencies weaken, when debt crises emerge, when confidence in paper assets erodes. It's a defensive position, not an aggressive speculation. And here's something crucial. Your decision about whether to hold gold should be based on your overall financial situation, your risk tolerance, your time horizon, and your understanding of monetary history and macroeconomic trends. It should not be based on whether some regulation changed or whether you saw an exciting headline. Let me take a moment to discuss how markets behave during periods of structural change, because this context matters enormously for your decision-making. We are not in a normal market cycle. We haven't been for years. The period since 2008 has been characterized by unprecedented central bank intervention, zero and negative interest rates, quantitative easing measured in trillions, and debt accumulation that has no historical parallel in peacetime. This environment has created distortions. Assets that would normally decline in value have been propped up. Risk has been mispriced. Speculation has been rewarded. And people have been conditioned to believe that central banks can always prevent serious downturns through monetary policy alone. But monetary policy has limits. And we are approaching those limits in ways that are becoming increasingly visible. When you see inflation persisting despite rate hikes, when you see yield curve inversions, when you see banking stress emerging in regional institutions, when you see countries discussing alternatives to dollar dominance, you are seeing the symptoms of a system under strain. Gold tends to perform well in environments of monetary stress, but not in a straight line. The path is volatile, frustrating, and full of false signals. There will be periods where gold seems to go nowhere, or even decline while other assets surge. This tests patience and conviction. It separates those who understand why they hold gold from those who are simply chasing performance. The key is understanding that gold is ultimately repriced based on confidence in monetary alternatives. When confidence in central banks, government debt, and fiat currency stability is high, gold languishes. When that confidence erodes, gold reprices higher. Basel III is relevant because it signals an institutional recognition that the old confidence may not be what it once was. This is the part of the conversation where I need to speak plainly about mistakes I see people make when they encounter information like this. Do not overleverage. Do not take out loans to buy gold. Do not liquidate all other positions to chase an asset class because regulations changed. Do not buy gold on margin or through complex derivatives you don't fully understand. These are catastrophic errors that have destroyed wealth countless times throughout history. Do not base your entire financial plan on a single thesis about gold, banking regulations, or monetary collapse. Diversification exists for a reason. You need multiple sources of stability and growth in your portfolio because the future is uncertain and even well-informed analysis can be wrong about timing or magnitude. Do not follow social media personalities or YouTube channels that promise specific price targets or guaranteed outcomes. Nobody knows exactly how this plays out. Nobody can predict with certainty when gold hits specific price levels or when systemic shifts accelerate. Anyone claiming otherwise is either deluded or dishonest. Do not panic buy or emotionally react to headlines. The time to make thoughtful portfolio decisions is when you're calm, educated, and thinking clearly, not when you're anxious or excited, not when everyone around you seems to be rushing toward the same trade. Do not confuse volatility with failure. Gold will have bad days, bad weeks, even bad years. This doesn't mean the long-term thesis is wrong. It means markets are complex systems with countless variables, and short-term price action is often noise rather than signal. And perhaps, most importantly, do not neglect the basics of financial health. No amount of gold will save you if you're drowning in high-interest debt, have no emergency fund, lack proper insurance, or haven't addressed fundamental cash flow problems. Gold is a component of wealth management, not a substitute for it. There's a critical distinction I want you to understand. Having information about Basel III, gold, banking regulations, and monetary policy is valuable. It helps you understand the world you're operating in. It helps you ask better questions and make more informed decisions. But information alone does not dictate action. You can understand everything I've explained in this video and still reasonably conclude that your current portfolio allocation is appropriate. You can understand the case for gold and still decide it's not right for your specific situation. What matters is that your decisions are based on knowledge rather than ignorance, on strategy rather than impulse, on long-term thinking rather than short-term emotion. Some people watching this are well-positioned already. They've thought about these issues for years. They have balanced portfolios that include hard assets alongside productive investments. They understand their risk tolerance and time horizon. For them, Basel III is simply confirmation of what they already knew about how serious institutions think about gold. Others watching this are just beginning to explore these questions. They're realizing that the financial system is more fragile and complex than they'd previously understood. They're wondering what it means for their savings, their retirement, their children's future. For them, this is the beginning of a learning journey, not a call to immediate action. Both positions are valid. What matters is that you're engaged, thinking, learning, and making decisions that align with your values and circumstances. Let's talk briefly about history, because this isn't the first time we've seen monetary systems under stress or gold's role change in the financial structure. In 1971, President Nixon closed the gold window, ending the direct convertibility of dollars to gold and effectively ending the Bretton Woods system. This was a watershed moment. It marked the beginning of a pure fiat currency era for the global reserve currency. In the decades since, we've seen periodic crises. The 1970s stagflation, the Latin American debt crisis of the 1980s, the Asian financial crisis of the late 1990s. the dot-com collapse, the 2008 financial crisis, and the pandemic-era money printing. Through all of this, gold has played a specific role, not as an investment that makes you rich overnight, but as an asset that maintains purchasing power across monetary cycles. An ounce of gold bought in 1971 has dramatically outperformed the dollar in terms of purchasing power, even though the path has been anything but smooth. What history teaches us is that monetary systems evolve. Currencies rise and fall, empires come and go, but certain forms of wealth preservation persist through all of it. This doesn't mean gold is magic. It means that across human civilization, when confidence in abstractions wavers, people return to tangible assets with no counterparty risk. Basel III's recognition of gold as a Tier 1 asset is significant precisely because it acknowledges this historical pattern. Regulators don't make these changes lightly. They do it because they recognize that in times of systemic stress, physical gold serves a function that paper assets cannot. So what should you expect going forward? How does this play out over the coming months and years? The honest answer is that nobody knows exactly, but we can think about probabilities and scenarios based on understanding the forces at work. If central banks and large institutions begin to increase their physical gold allocations in response to Basel III incentives, that creates sustained demand pressure on a relatively small and inelastic market. Gold mining production is essentially flat. Above-ground supply grows slowly. If demand increases structurally from the institutional side, prices will adjust to reflect that reality. If sovereign debt concerns continue to escalate, if inflation remains persistent, if geopolitical tensions drive countries to diversify reserves away from dollar-denominated assets, these factors compound the effect of regulatory changes. Each force reinforces the others. But this doesn't happen overnight. It happens gradually, with plenty of volatility and reversals along the way. Markets oscillate between fear and confidence, between risk-on and risk-off sentiment. Gold's price reflects those oscillations, even as the underlying structural case strengthens. What disciplined investors do in this environment is maintain their strategy regardless of short-term noise. They don't try to time every move. They don't chase price spikes or panic during corrections. They understand their thesis, size their positions appropriately, and let time and fundamentals work in their favor. This is not sexy. It's not exciting. It won't make for viral social media content. But it's how wealth is actually preserved and grown over decades rather than destroyed in pursuit of quick gains. I want to acknowledge that not everyone agrees with the perspective I'm presenting here. There are intelligent, informed people who think gold is a relic, that cryptocurrencies have replaced its function, that productive assets always outperform over time, that central banks have everything under control. These are not stupid positions. They're based on different assumptions about how the world works and what the future holds. And they could be right in certain timeframes or scenarios. My goal is not to convince you that gold is the only answer or that skeptics are fools. My goal is to help you understand what's happening with Basel III and why it matters within a broader context of monetary evolution and risk management. You should absolutely consider alternative perspectives. You should read people who disagree with the gold thesis. You should think critically about your own assumptions and biases. That's how you develop genuine understanding rather than just adopting someone else's narrative. What I would argue is this: regardless of whether you personally choose to hold gold, understanding why major institutions and regulatory bodies are treating it as a Tier 1 asset is valuable financial knowledge. It tells you something about how the system thinks about risk, stability, and value preservation during uncertain times. Zoom out for a moment and consider what we're really witnessing. We're living through a period of monetary transition. The post-2008 era of unlimited central bank intervention is reaching its natural limits. The debt accumulated cannot be repaid in real terms. Inflation is proving more persistent than central banks anticipated. Geopolitical fractures are accelerating de-dollarization efforts. Basel III's treatment of gold is one small piece of a much larger picture. It's part of a slow institutional recognition that the financial system needs more stability, more real assets, more insurance against monetary policy failures. This doesn't mean the system collapses tomorrow. It doesn't mean fiat currencies disappear. What it means is that we're entering a period where wealth preservation becomes more important relative to wealth accumulation, where understanding risk matters more than chasing returns, where diversification across asset classes, including hard assets, becomes essential rather than optional. For younger investors, this might feel abstract. You've only known a world of rising asset prices, central bank support, and paper wealth creation. But financial history is longer than any individual lifetime, and patterns repeat even when circumstances change. For older investors, this might feel familiar. You've seen crises before. You understand that confidence in systems waxes and wanes. You know that having some portion of wealth and assets that don't depend on government promises or institutional stability is simply prudent. Both perspectives are valid. The question is what you do with the information available to you right now. Let me offer some practical guidance without crossing into specific financial advice. Educate yourself continuously. Read about monetary history. Understand how banking systems work. Learn about different asset classes and their risk characteristics. The more you understand, the better decisions you'll make. Assess your current portfolio honestly. Do you have appropriate diversification? Are you overexposed to any single asset class or sector? Do you have insurance against monetary risk or systemic stress? These are questions only you can answer based on your situation. If you decide to allocate toward physical gold, do it thoughtfully. Research reputable dealers. Understand storage options. Consider allocated and segregated storage if holding significant amounts. Think about liquidity and access. Don't rush. Consider working with a financial advisor who understands hard assets and monetary history, not just someone who sells whatever financial products their firm pushes. You want independent thinking and genuine expertise, not sales pressure. Set clear expectations for yourself. If you buy gold, know why you bought it and what would cause you to reconsider. Have a plan. Don't just follow the crowd or react to headlines. And most importantly, maintain emotional discipline. Markets will test you. Prices will fluctuate. News will be confusing and contradictory. Your ability to stay calm, think clearly, and stick to your strategy matters more than any tactical decision about timing or allocation. We've covered a lot of ground in this conversation. Basel III regulations, institutional incentives, macroeconomic forces, historical context, psychological factors, practical considerations. All of it matters. But if you take away only one thing from this video, let it be this. Understanding prepares you better than any prediction ever could. I cannot tell you that gold will reach a specific price by a specific date. I cannot tell you that the financial system will crack in any particular way or time frame. Nobody can. Anyone claiming otherwise is selling something. What I can tell you is that the forces shaping our monetary system right now are significant. The debt levels are real, the inflation pressures are real, the geopolitical tensions are real, the regulatory changes we've discussed are real. And in response to these real forces, institutions are making real adjustments to how they think about risk, stability, and value preservation. Basel III's treatment of gold is one visible manifestation of those adjustments. Your job is not to panic or to rush into anything. Your job is to stay informed, think critically, make balanced decisions, and maintain discipline regardless of market noise. Whether you hold gold or not, whether you agree with everything I've said or not, you're here because you're thinking about these issues. That puts you ahead of most people who never question how money works or why their purchasing power erodes or what protects them when systems wobble. Keep learning, stay curious, question assumptions, including mine. Build a financial approach that makes sense for your life, your goals, your values, and your circumstances. The world is changing. The monetary system is evolving. Regulations like Basel III are symptoms of deeper shifts. Understanding these dynamics doesn't guarantee success, but it gives you a fighting chance to preserve and grow wealth through whatever comes next. Be patient, be disciplined, be informed. That's how you navigate uncertainty. Thank you for watching. Stay sharp out there.